Hey guys, welcome back to the channel. On today's video, we're going to be looking at a very popular ETF. It's Vanguard's High Canadian Dividend Yield Index ETF, ticker symbol VDY. Now, the reason we're going over this video today is whenever I'm on a Reddit forum, I'll see a lot of questions coming up about, hey, I'm a Canadian, what's the absolute best ETF I can put my money into and just kind of set it and forget it. There's a couple popular options that come up, but VDI is definitely one that comes up a lot. So I thought we would go over it and decide if it's a good investment for me, for you, who's it for, what kind of returns are we going to be expecting in the future, and what does it hold. So we're just going to go over some quick facts. They have just under $1 billion of total value. It started in 2012, so we don't really have that old of a chart. The management expense ratio, this is an important part right here, it's at 0.21%. So this is what I would say. It's not that high in its totality. However, if you look at the number of holdings there are only a total of 40 holdings in this ETF. So this is a little bit high in this regard. Because if you look at other ETFs like XEQT, there's like 10,000 different holdings. That should have a higher management expense ratio in my opinion. I don't think 0.21 is justified in this situation, but I mean, it's really not that much, guys. It is pennies on the dollar, just, to be fair about it. So they do pay out monthly, which a lot of people like because this is the type of fund that people have for income, all right? So also what's important to take a look at is how often is it traded, because this can influence on your bid and your ask spread. So if we see here, the average daily volume is just under 170,000 units, which is very high. So you don't need to worry about it too much. You can put in market orders and they'll be filled. You don't need to worry about it. Vanguard's going to give themselves a medium risk rating on this ETF, and I tend to agree with it. Overall, I don't think it's a very risky portfolio. However, it does have high sector concentration. So we're going to go take a look at that. Just keep it in mind. It's not for someone who's very, very scared of things, someone who wants money invested into bonds. This fund has 0% invested into bonds, and I really like that. I cannot stand when ETFs have a bond function. Honestly, right now with inflation going up, bonds is just, it's deflationary. You're going to lose money on it. They're virtually useless right now. I do not want that in any ETF that I hold. So on the right of the screen here, we're going to see an investment mix by sector. Now, the first and biggest sector is financials, okay? It's coming in at just under 60% of the total fund. So obviously this means every $100 you're putting in, $60 is going right into Canadian financials, okay? Now, this is super overweight financials because it is a Canadian ETF. In Canada, we do a couple things really well and not too much else. We have our banking and insurance sectors. That's our number one thing, and then the next is energy, okay? So, and that's, if you look at the fund breakdown here, represents this, okay? So this is the type of thing you're going to expect when you invest in Canada. The third biggest is telecom. This is your Rogers, this is your Bell, this is your TELUS. Then utilities, some of you might know I'm very fond of this sector. Basic materials, 3%, industrial 0.2, real estate 0.2, and consumer discretionary 0.1. So those are pretty much just not even worth mentioning. Now, let's take a look at the top 10 holdings, okay? Number 1, Royal Bank of Canada, 14%. Number 2, TD Bank. Number 3, Enbridge. Now, they've classified Enbridge as energy. I would classify it as a midstream, but that's fine. It's nitpicking a little bit. Fourth is Bank of Nova Scotia, just under 8%. Bank of Montreal, then TC Energy, 5%. CIBC at 4.8%. Manulife, getting the insurance in there, at 4.3%. Bell Canada at 3.9%, and Canadian Natural Resources to round out the top 10 at 3.6% of the total fund. Now, if you look here, guys, there's 40 total investments. This top 10 list that I just read you out, it is comprised of 70% weighted of the fund, okay? So for every $100 you put in, you're putting $70 of that 100 right into this top 10 stocks here, okay? And that's how that works. We're just going to take a look here on the left hand of the screen of historical returns for this ETF. Now, past results don't really mean much for the present day or for the future, but it's good to have an idea of where you came from, okay? So if you see here, plus 20%, plus 8, minus 10, plus 26, plus 8, minus 10, plus 21 minus 1. So overall it's done really well. It's, you know, it's beaten the average of the TSX by far, like handily. So you've done pretty well over time. The key is to just not sell on the down years here, guys. And these numbers definitely include dividends being reinvested, okay? Just keep that in mind. So if someone had invested $1,000 in this ETF in 2012, they would now have $2,100 as of April this year. Okay, so that works out to an annual compound rate of 9%, which is really good, and it's comparable to the S&P compound rate of return as well. The trailing 12-month yield is 3.82%, and yet again, that's paid monthly. Now, I just want to point out that that's the trailing 12-month, okay? If you buy in today, you're not going to get 3.82. It depends when you buy, but that is pretty healthy, and I mean, we do have really high dividend payers in there. All the energy and all the financials are really hefty dividend payers, and that's why it's pretty high. Overall, I think this is a great product. I think it's a great ETF for a lot of people. It's not going to work for everyone. For example, it's not going to work for me. I hold most of these companies individually, and you know, by doing that, I can buy more or less. I can weight them the way that I want, that fits my portfolio, that fits my goals. I'm a very hands-on investor, so that's why it's not for me, but this will definitely work for a lot of people, okay? Young Canadians who do not want to do a lot of research into these individual companies, that they do not want to pay a lot of high fees for products like mutual funds, this is going to work for them. They're going to get their distributions monthly, so they're getting money into their accounts, they're progressing, they're creating a dividend snowball, they can feel good about that. Overall, I would be very comfortable recommending this ETF to family and friends who don't have the time or interest to really read up on these companies, to check out their annual reports or even their quarterly reports. I hope you guys enjoyed this video on VDY. Let me know if you own it, are thinking about getting it, or if you have a better ETF in mind. Anyways, I'll catch you on the next video.